Okay, our topic, we are going to look at Cashbook. So Cashbook is one of the topics in financial accounting. So let's look at the Cashbook, the meaning of Cashbook. So what is Cashbook? Cashbook is a book of original entry where all cash transactions are recorded. So Cashbook is a book used to record all cash transactions. So the key point there is that Cashbook is used to record all cash transactions. So any transaction on cash are recorded on the Cashbook. So it means that it discriminates any credit transaction. Any transaction that is done on credit should not appear in the Cashbook. It is only cash transaction that should be recorded in the Cashbook. So you can say Cashbook is a book that is used to record cash receipts and cash payment. So it is a book used to record the cash receipts and cash payments of an organization. So when an organization receives cash, they record it in the Cashbook. When the same organization pays cash, maybe when they pay for something or for item or for goods they purchase in cash, you have to record it in the Cashbook. When they make sales and they receive cash from the transaction, then that transaction should appear in the Cashbook. So that is what it's talking about. Cashbook is a book that is used to record all cash transactions. It is a book used to record cash receipt and cash payment. So if you look at this, you can say Cashbook is a book that is used to record cash inflow and the cash outflow of the organization. So the cash inflow are those cash coming into the organization, while the cash outflow are those cash going out of the organization. So let's look at this particular word. Cashbook is a book of original entry. Sometimes, some people, when you talk about book of original entry, they may not be able to understand what this statement is talking about. So book of original entry means that it is a book where transactions are recorded in the first place before they are being transferred to the main book. So you can say that Cashbook is a book of preliminary entry. It's a book of first entry. It's a book of primary entry. So book of original entry, like I said before, is where you have to record transaction in the first place. So before you now be able to transfer them to the main book, which is general ledger. Now let's come back to this one. From this black box there, you see it. Cashbook signifies cash inflow. Okay, let's read it. Cash inflow signifies the cash coming into the organization. Cash outflow signifies the cash going out of the organization. So you look at this box. It says Cashbook is divided into two equal parts or equal size. Cashbook is divided into two equal size, which is debit side and the credit side. See it here. So the debit side is this particular side now. I decorated with the pink color, while the credit side is the particular side I decorated with the green color. So this side now is where all this cash coming into the organization are recorded. You see where I wrote cash receipt or cash outflow. Then look at this particular side. You see it cash payment or cash outflow. So this one cash received or cash inflow, while this one is cash received or cash outflow. So the money coming into the organization. Now you see it date. These are the format. This is the format of a Cashbook. This is the format. This one date, particulars. So date, you have to record the date of the transaction, the date which the transaction took place. Then the particulars, then you record the item of transaction. If it is good that the organization sold, they have to record it there as sales. So then the amount they receive from the sale of the goods, all these things should appear in the debit side. The same thing happens in the credit side, where cash outflows are recorded. Example, when organization purchase item, maybe they purchase furniture by cash or in cash, or they purchase goods for cash, or they purchase furniture for cash, or anything they purchase, they bought for cash, they should appear in the credit side. Then if they pay salaries in cash, they have to record it in the cash in the credit side. So Cashbook is not all about cash receipts. There are some transactions that are done through bank. As far as the money is received, as far as the cash is received, that is it should appear in the Cashbook. So generally, Cashbook is used to record all cash transactions. So any transaction that is on credit should not find its place in the cash book. So there is nothing like credit transaction. So it discriminates any form of credit transaction. Bought goods on credit, it should not appear in the cash book. Sold goods on credit, it should not appear in the cash book. So it is bought goods for cash, sold goods for cash, or anything for cash. Anything for cash should appear in the cash book. Now let's look at the components or the things that make up the item that make up the cash book, that make up the debit side of the cash book. See it here. Examples of cash receipts. Look at this. Capital introduced in the business. So when an organization, when the owner introduces capital to the business, so it is a cash inflow. This is a cash inflow because that capital, that money he introduces, is coming into the organization. So the business is the one receiving the cash. So it is a cash receipt. It is a cash inflow. That's why capital is recorded in the debit side of the cash book. And also capital is the first entry in the cash book. When there is capital maybe when there is capital injected in the business, so it should be the first thing to be recorded in the cash book, in the debit side, because it's a cash inflow. Now we look at the sales. When an organization makes sales, they are able to receive cash or transfer from the customer. So these are part of cash inflow because it is the money that the organization is expecting to receive. In fact, the organization has already received the cash or the transfer from the customer. So it is cash inflow. Look at this one, the cash received from customer. So cash received from customer is cash inflow. This one, interest or commission received, they are cash inflow. Now let's look at the cash outflow. Cash outflow, I mean the examples of cash payment, which is cash outflow. Yes, purchases. The first one is purchases. So you talk about purchases. Purchases signifies the goods bought for cash. When organization bought goods for cash, when they bought goods in order to sell it, so those goods they purchased for cash, those goods they bought for cash, they are recorded in the cash book. So another one is salary paid. Salary paid, as far as they have already paid the salary in cash or in check or by check, so it should be recorded in the cash book. Then, so the same thing happens to purchases. If they purchase goods for cash or by check, it is recorded in the cash book because it is the cash inflow. Then look at the office rent paid. So office rent paid is part of the cash outflow of the organization. So these are the items I mentioned here. They are the components of cash outflow because when you do these transactions, the money is going out of the organization. Electricity bill paid. All these things are the money going out of the organization. They are cash outflow. Therefore, they are recorded in the credit side. In this credit side is where they are recorded. So my next video now, I'm going to give you illustration where we are going to prepare these transactions. I'm going to give you set questions. Then we now start preparing a single column cash book.